Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge podcast. Last week, we had a really good time, and I gave you a lot of good information on the pros and cons of the taxable bucket. So today, we're going to spend a little bit of time talking about the pros and cons of the tax-deferred bucket, which is one of the most favorite buckets for many of my clients, and obviously the vast majority of Americans in the United States. Now, as you all know, there are three IRS tax buckets that we speak of, and we talk about often in every single seminar, webinar, and podcast that we do on an ongoing basis. So you have the taxable bucket, the tax-deferred bucket, and last but not least, the tax-free bucket. Now, in the taxable bucket, which is something that we discussed last week, the money that goes in is after tax. The money is taxed every single year, depending on the amount of money that is made on that basis. And then when finally the assets in the taxable bucket are sold, or some of the assets in the taxable bucket are sold, then you also going to pay an additional tax. So as you all know, and as we discussed from a taxable standpoint, the taxable bucket is not a very good one, but it does provide a lot of flexibility and liquidity that is very important for the vast majority of Americans. Now, because of that reason, because of the tax liability inside the taxable bucket, it is very important to maintain the adequate amount of assets in that bucket, because otherwise you may be paying way too much money in taxes that you're not supposed to, or that you shouldn't have to if you don't want to at that point in time. So today we're going to spend a little bit of time, obviously, on the tax-deferred bucket and the importance of understanding all these tax buckets is very, very critical from a retirement standpoint, from a business perspective, and from managing your tax liability every single year for many years to come. Number one, it gives you the ability, the understanding of these taxable buckets gives you the ability to manage your tax liabilities efficiently. If you know what you're doing, or you're working with somebody who's a retirement strategist or someone that specializes in tax planning, then he or she is going to be able to help you mitigate your tax liabilities from one year to the next. You know, sometimes you may want to take a tax liability in the current year. Sometimes you want to push it off to the following year. Sometimes you want to find ways to minimize that tax liability in order to maximize your income for a given year, or to minimize your income for a given year. So understanding these taxable buckets gives you the ability to manage your tax liabilities effectively and efficiently as well. The second thing is that it helps you reduce your future tax liabilities through proper tax planning. One of the many challenges that many of my clients have prior to meeting with me is the fact that they don't know what their tax liability is going to be from one year to the next. And the reason for that is that they've never done a true tax planning preparation. You know, most of the clients that we engage, and I would argue that many of you on this call, primarily do tax preparation. And there's a big difference between doing tax preparation and doing tax planning. When you do tax preparation, you're looking in the rearview mirror. You're pretty much are going to sit down with your accountant, and you're going to determine what the tax liability was for the previous year, and it is what it is. When you do tax planning, not only are you doing the tax preparation and looking into the rearview mirror, but it also gives you the ability to look through the windshield onto the next 3, 4, 5, 6 years and be able to do tax planning accordingly in order to minimize the tax pain that you may suffer in subsequent years. So obviously today we're going to be spending the remaining of our time in discussing the pros and the cons of the tax deferred bucket. And first, let's start talking about some of the advantages, because all of these buckets that we're going to be discussing and that we have discussed up until today do have certain pros, and they also have certain cons. They have advantages and disadvantages. So it is apropos to make certain that whenever I communicate to my clients, that I do so through an educational perspective. So let's dig in and do a deep dive into some of the advantages of the tax deferred bucket. As most of you know, the tax deferred bucket is very well known to Americans, because that is the bucket that contains your 401ks, your IRAs, your 403bs, your deferred compensation programs, your pensions, and so forth. The money in that bucket goes in pre-tax. The money grows tax deferred. But then when you pull the money out, you have to pay taxes on the whole thing, unless you've done proper tax planning. So what are some of the advantages to the tax deferred bucket that all of us have a tendency to know fairly well? Well, number one, you do have a systematic growth of retirement assets, because you're making contributions on an ongoing basis, and these are contributions that are earmarked for retirement purposes. So you're not going to be touching that money for the next 10, 15, 20, 25, 30, maybe 35 years, depending on the age that you started making contributions to these plans. You also have a potential employer match. If you happen to be in a 401k, whereby your employer is matching your contributions, and that's a win-win. So because of the fact that you are receiving a match on the amount of money that you're putting into that 401k, up to certain limits that the employer will dictate from a business perspective. Number three, you're getting a tax deduction on contributions. Now, that could be a good thing and that could be a bad thing, but let's stick this tax deduction as an advantage because of the fact that if you're earning $100,000 a year and you're making a $10,000 tax deduction to your qualified plan, then you're going to be able to take a deduction along those lines from a business perspective. Now, that's very important to note from that positioning as well. And because of the fact that you also have a tax deduction on your contributions, you also have a tax deferral during the accumulation of these plans as well. So that's something very important for us to note from a business perspective. Now, what are some of the disadvantages? And there are many, many of them. Now, the challenge for the vast majority of Americans, and the challenge for many, many people that we deal with on an ongoing basis, is that when they're making contributions to their qualified plans, their 401ks, their IRAs, their 403b, etc., they only look at the advantages, but they're not well educated on the disadvantages of these plans, as we are going to go through at this point in time. Now, number one disadvantage to these types of plans is what I call the 3 C's. You lose the care, custody, and control of your money. So whenever you put money into a 401k or an IRA, you're pretty much losing control of those assets for many, many years to come. So the care, the custody, and control of your money is given up to the IRS and the IRS code based on the directives that you may have at that point in time. Now, the second disadvantage to having these qualified plans or money, or to having money in the tax deferred bucket, is the difference between tax savings versus tax deductions. You have no idea how many times I have had conversations with accountants and CPAs, and obviously, we are a tax preparer firm, so we do tax planning and tax preparation for our clients, but you would be surprised how many clients walk into our offices and they pretty much tell us that they're getting a tax savings on their contributions to their 401ks and IRAs. In reality, there are no tax savings. There's no tax savings when you make a contribution to a qualified plan. Now there's a tax deduction for the year that you're making the contribution, but there is no tax savings because what you are doing is you're doing tax postponement, meaning that you're deferring the tax liability today so that you can pay it at some point in time in the foreseeable future. Now, because of the tax and the tax liability postponement, one of the major questions that you need to ask yourselves as you're starting to put money away into the tax deferred bucket is, where will taxes be in the future? If you feel that taxes are going to be a lot higher in the future than they are today, then it wouldn't make any sense for you to max out and make contributions. You can up to a certain level to your tax deferred bucket, because why would you want to defer the tax liability today so you can pay it at a much higher tax rate at some point in time in the future? So that's question number one. Now, if you feel that taxes are going to be lower in the future than they are today, or that you may be in a lower tax bracket in the future than you are today, and I would argue that's probably not going to be the case unless you've been a total failure in your financial life, then it might make sense for you to be able to maximize your contributions to the tax deferred bucket today. Now, obviously, we have to deal with whenever you put money into a tax deferred bucket, you're pretty much entering into a partnership with the IRS. And when people fail to realize this, what belongs to the IRS always belongs to the IRS. So let me give you an example. If you put $10,000 into a qualified plan in 2018, you're taking a deduction. So if you are earning $100,000 and you put $10,000 into your qualified plan, then obviously you're going to pay taxes unless you have other deductions and exemptions and credits. You're going to be paying taxes on $90,000. But you are postponing that tax liability. So if you're in the 30% tax bracket, I'm just using 30% to make the math simpler. Had you paid taxes on that $10,000, you would have paid the IRS $3,000 in taxes, and you would have kept $7,000 for yourself and for your family. Well, because of the fact that the IRS allowed you to put that money into that account, into that tax deferred bucket on a pre-tax basis, they're lending their $3,000 that you should have paid in taxes, they're lending that money to you. Now, they're not giving you that money, which means that as you start to earn money on that $10,000, whatever the $7,000 earns after tax will be yours. Whatever the $3,000 that originally should have been paid to the IRS earns will belong to them. So as the account increases from one year to the next, from each decade to the next, as the account increases, so does your tax liability. So let's say that 30 years from now, or let's say 20 years from now, you have $1 million in that account and you're still in that 30% tax bracket. Well, $300,000 of that $1 million belongs to the IRS, and the net of $700,000 would belong to you. And again, if it goes to $2 million, $600,000 would belong to the IRS, and the $1.4 million will then belong to you. So it is very important to understand that if taxes were to go up just 1%, at time of retirement, then you would have been better off not having so much money in your tax deferred bucket. Remember, the money goes in pre-tax, it grows tax deferred, but then is fully taxable upon distribution unless you do proper tax planning, and then you may be able to do some tax planning hedging that would allow you to minimize the tax liability out of this bucket at time of retirement. So it is very important to note that when you start putting money into the tax deferred bucket, you're entering into a partnership, business partnership with the IRS. And guess who the controlling partner in that partnership is definitely not you. It is the Internal Revenue Service. Obviously, when you start putting money into the tax deferred bucket, another area of concern, which would be point number 5, is the lack of liquidity. So therefore, if you take any distributions prior to age 59 and a half, then you're going to have to pay taxes on the distribution plus a 10% penalty. Now, some people may say, well, Bert, I'm involved in a 401k, so I can borrow money up to $50,000 or 50% of my account value. And the answer is yes. But when you borrow the money, yes, you're paying the interest back to yourself, but you have to pay the interest with after-tax dollars. And then when you pull the money out eventually at retirement, after you have paid that loan back with after-tax dollars, then you will be taxed on the entire account value all over again. So you have to be very careful that, yes, you may be paying the interest back to yourself, but at least on that portion of the money that you borrowed and then paid back after tax, when you pull that money out again, then you're going to be paying a double tax on that $50,000 that you borrowed, or any specific amount that you may have borrowed, not to exceed 50% of your account value and or $50,000. So the 59.5 rule is very prevalent. Now, there are some ways that you can avoid that, and we're not going to get into a discussion on that today, but one of those would be this to do a 72T. Which is something that we use when we do tax planning for our clients. So if you need more information on that and you want to avoid that tax penalty prior to age 59 and a half, please feel free to call us and to call me, and we'll go into more detail on that. The second rule and the second handcuff, in addition to the 59 and a half rule, that the IRS places on your contributions to the tax deferred bucket, is what is known as the 70 and a half rule, or the required minimum distribution rule. It basically states that upon reaching the age of 70 and a half, you must, by law and by the IRS code, to start taking distributions out of your qualified plans, whether you have a need for the money or not. And then at that point in time, obviously, you're going to have to start taking distributions. But if you fail to take a distribution on any given year, then not only are you going to have to pay taxes to the IRS on that distribution that you should have taken but you didn't take, but you're also going to have to pay an excise tax penalty in the amount of 50%. Yes, 50%. So in reality, the only time where you have control of your tax deferred bucket is an 11-year period between the ages of 59 and a half and 70 and a half, in which you can do anything that you want. Prior to 59 and a half, you have penalties, and then after age 70 and a half, you also have penalties. Now, we've done a number of webinars and podcasts on the rules of engagement when it comes to required minimum distributions, meaning reaching the age of 70 and a half. And you have to be very careful depending on the taxable year that you're going to be. So if you turn 70 and a half in 2018, you must take your first required minimum distributions no later than April 1st of 2019. Now, it's not April 15th, it's not January 1st, it is actually April Fool's Day. Now, in the first year that you're eligible and required to take that minimum distribution. If you turned 70 and a half in 2018, you could have taken that distribution in 2018, but the IRS allows you to postpone that distribution until April 1st of 2019. Now, that could be a good thing for you, and that could be a challenging thing for you. Obviously, unless you do proper tax planning, it's going to be very difficult to determine whether it would make sense for you to take your 70 and a half distribution in the 2018 year versus 2019. And the reason why I'm saying that is that if you delay taking your 2018 distribution of required minimum distributions for this year, and you delay it until April 1st of 2019, then you must take that 2018 distribution by April 1st of 2019. But on top of that, your 2019 distribution must be taken no later than 12/31 of 2019, December 31st of 2019. So if you delay taking the distribution in 2018, guess what? You're going to have to take 2 distributions in 2019. So unless you know what your income is going to be, what your deductions are going to be in 2019, what your tax liability may foreseeably be in 2019, then how are you going to know whether it would make more sense for you to take your distributions in 2018 versus 2019? Now, obviously, the other challenge that would be number 7, and another disadvantage to the tax deferred bucket is what is known as provisional income negatives. That means that when you take money out of the tax deferred bucket, not only does it have a negative impact on your reportable income for the year, because everything coming out of that bucket is taxable, but also it could have a negative impact on your Social Security benefits and also on the Medicare premiums that you pay once you reach the age of 65. And the reason for that is that, provisional income calculation is a calculation that we do for many of our clients that are approaching retirement and are thinking about either taking their Social Security benefits, or many of them are already taking Social Security benefits. And what the provisional income calculation basically says that if 100% of your income came from Social Security benefit sources, then that income would not be taxable to you or your family. The taxation of Social Security benefits is not started and is not caused by the Social Security benefits themselves, but is caused by the provisional income of all the other income sources that you may have coming to you at time of retirement, and that you must be filing taxes for on an ongoing basis from one year to the next. So, for instance, in order to calculate your provisional income, the calculation software that we use will take 50% of your Social Security benefits in retirement. To that, we're going to be adding ordinary income. Any work that you may, any W-2 work that you may be generating, any 1099 work that you may be generating will be considered ordinary income. If you're working full time or part-time, that will be considered as well. Also, any distribution that you take out of this tax deferred bucket will also get added on to the provisional income calculations. Any capital gains that you obtain in a given year, any capital gains that you obtain on a given year, not only would have paid capital gains tax depending on what tax bracket you are on the capital gains side of the house, but it will also have a negative impact on your Social Security benefits. And then last but not least, any income that you generate out of municipal bond funds. Now, I know many of you are going to say, well, wait a minute, Bert, municipal bond funds are received federal income tax-free, and the answer is yes. But although municipal funds are received federal income tax-free, they get added on to the provisional income calculations in order to determine what percentage of your Social Security benefits will be taxed in retirement. If you do a good job and you've been doing tax planning for a number of years, your Social Security benefits should be totally tax-free. If you don't do such a good job, 50% of your Social Security benefits may be taxable. And if you do a horrible job, then up to 85% of your Social Security benefits may be taxable to you and your family in retirement. Obviously, Medicare premium is dictated by your adjustable gross income at the end of the year. So the more money that you report under your provisional income calculation, the more money you take out of this tax deferred bucket, the more challenges and the more liabilities you may incur along those lines. So because of the fact that the tax deferred bucket not only creates a taxation for the bucket itself, same as a taxable bucket, but both of these buckets that we are now discussing and that we talked about last week have a negative impact on your Social Security benefits and your ability to maximize the income from your Social Security benefits on an ongoing basis. By the way, those of you that pay taxes on your Social Security benefits, there's a very high probability that you may run out of money 5 to 8 years earlier than those of you that are receiving your Social Security benefits tax-free. The reason for that is simple. You're gonna have to offset the difference of the taxes that you're paying on your Social Security benefit, so you may be forced to take more money out of your taxable bucket and or your tax deferred bucket in order to offset that difference. And by doing so, you're actually compounding the problem and you're accelerating the distribution of your assets in retirement, which may force you to run out of money 5 to 8 years sooner than if you didn't have to pay taxes on your Social Security benefits. Some final thoughts for all of you to consider. Limit the amounts of assets in this bucket. You have to do a proper net present value calculation in order to determine what is the proper amount and the adequate amount of assets you should have in the tax deferred bucket, the same exercise that we went through in the taxable bucket. I would argue that anything over $500,000 in the tax deferred bucket, it is not going to be apropos from a taxable standpoint. So you have to be very careful about that. Some, depending on your tax liabilities, it could be anywhere between $350,000 to $400,000. But we do those calculations because our goal is to find the optimum amount of money and assets that you should have in the taxable bucket and the tax deferred bucket because of all the tax liabilities that these buckets create for you, your family, and your business in retirement. Another thought is contribute to the match on qualified plans, but not more than 7% of your gross income. So you want to make certain that you can make the right amount of contributions depending on how many years you have to retirement and forecasting an internal rate of return on those assets in order for you not to go above and beyond that threshold that would now create all kinds of different issues and concerns during your retirement life and distribution. Another thought would be provisional income and tax planning may assist in receiving IRA distributions with proper tax hedging. One of the things that we try to do for our clients is get them as close as we possibly can to a 0% tax bracket. Now, we all know that taxes are going to more than likely double in the future because otherwise our country is going to go bankrupt. And there's a lot of literature along those lines. I mean, we're sitting at almost $22 trillion in our national debt. We're sitting at $115 trillion for the unfunded liabilities for Social Security, Medicare Part D, and the debt and the interest on the national debt. So taxes are going to have to be very, very high in the future. But if we can get your tax liability to a 0% and giving you the three C's, the care, custody, and control of your assets, then you would be doing, and you have done a much, much better job than the vast majority of Americans that are maximizing their contributions to these qualified plans. Now, when we do tax hedging for our clients in the tax deferred bucket, by having the right amount of money and by doing all of the provisional income calculations, we do have the ability to take just enough money out of the tax deferred bucket in order to make certain that we don't have to pay any taxes to the IRS from a business perspective. Now, another thought is that once adequate limits are reached, you may want to shift your annual after-tax earnings and or contributions out of this bucket to the tax-free bucket, and we're going to be having a discussion on the tax-free bucket next week. And how do you do that? Well, number one, by shifting your contributions. Instead of making traditional IRA contributions, make a Roth IRA contribution. If you're making contributions to your traditional 401k, find out if your employer allows for contributions to a Roth 401k, and you may want to shift to either 100% or a lesser percentage than 100 to that tax-free Roth 401k contribution in order to receive those benefits in the future. You can also do IRA conversions. Now, if you're under the age of 59 and a half and you want to do an IRA conversion, you have to be very careful. Again, 72T calculations will allow you to do so without having to pay the tax liability or the 10% tax penalty for early distribution. But most of you, if you're over the age of 59 and a half, then you do have the ability to make IRA conversions. The ticket to get in is you have to be able to pay the tax today. But as we always talk, there's a very high probability that taxes are going to be a lot higher in the future than they are today because our liabilities are way too great for the government to be able to do anything other than raising taxes in the future. You can also do, as I just talked about, Roth IRA and or Roth 401k contributions as well. So obviously, we're approaching the end of the year. We've been talking about the three taxable buckets, the IRS tax buckets, the taxable, tax deferred, and next week we'll be speaking about tax-free. But I'm about to give you a tax planning offer that I think is going to be very, very critical for all of you. If you want to get rid of and get out of this rat race, I think it would be incumbent upon all of you to stop doing tax preparation and start doing tax planning. So if your tax preparer does not have the ability to do tax planning on your behalf, please feel free to reach out to me. I'll give you this in the next few seconds. But if you reach out to me, we can set up a 30-minute video conference or conference call in which I'll give you the ability to ask any specific tax questions or planning questions that you may have. And then if it makes sense for us to move forward, then you'll have the ability through my firm and I to create a customized tax-preferred retirement blueprint that would include your tax preparation for the year. It will include a tax-forward planning report that will take a look at your tax planning liabilities not only for 2018 but for the next 5 years. It will include a Social Security report that will provide you with the ideal time for you to start taking your Social Security benefits. And not only do we take into account the timing of it, but also we take into account the tax liability as well. We will also provide you with a retirement distribution report that will take a look at all your assets And by doing so, and by doing proper future value calculations, we'll determine which bucket of assets you should be invading first during your retirement years, and then we'll create a report along those lines. And then last but not least, we will provide you in this customized tax-preferred retirement blueprint with a Fatal 4 risk management report. And this is a report that we do with all our clients because a vast majority of our clients, when they get closer to retirement, they fail to take a look at the Fatal 4. What are the 4 things that can really destroy their families and also their retirement from a business perspective? The risk of dying too soon, the risk of living too long, the risk of living with a disability, and the risk of living with eroding factors like taxes, inflation, stock market volatility, interest rate volatility, and so forth. So with all that being said, I want to leave you with the final thought that I always leave each and every one of you every week on every podcast, webinar, and seminar that we do, is that my number one goal is to help all of you and your families to change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, I hope that you enjoyed this podcast. Look forward to speaking to you again next week, in which we're going to be discussing the most important bucket in the arsenal of the IRS code, which would be the tax-free bucket. So until then, have a great weekend, have a great Christmas and or holiday season, and we'll talk to you soon. Take care.